Hey guys, welcome back to Money Without Borders. And today we're tackling one of the most misunderstood topics in investing, capital protection, and what it really means for your money. What exactly is capital protection and how does it work?
But it's quite simple. It means that you design your investment so that the original amount you put in is safeguarded. It's like wearing a seatbelt while driving. You can still move forward, but if something hits you or things go wrong, you're protected. And this approach is especially useful for people who, not that we can all afford to lose money, but can't afford major losses, okay, like those nearing retirement or anyone relying on their savings for income. It's about balancing security with opportunity.
Hey guys, welcome back to Money Without Borders. And today we're tackling one of the most misunderstood topics in investing, capital protection, and what it really means for your money. And as always, I'm joined by the lovely Annette Houlihan. Annette is a 40-plus year international financial advisor. She started her career in the UK, and then in 1995, she moved to Hong Kong, where she began advising multinational professionals and expanded into estate planning. So for the past 4 years, Annette has been in Canada, also helping clients worldwide with down-to-earth, easy to understand advice.
Hi guys, thanks Cara for the introduction.
Hi Annette.
Before we dive in, what are the key questions that you hear most about capital protection, Cara?
What exactly is capital protection and how does it work?
The easiest thing to do is share a slide, so just bear with me, and then I can explain in a little bit more detail, but it's quite simple. It means that you design your investment so that the original amount you put in is safeguarded, okay? It's like wearing a seatbelt while driving. You can still move forward, but if something hits you or things go wrong, you're protected. And this approach is especially useful for people who, not that we can all afford to lose money, but can't afford major losses. Okay, like those nearing retirement or anyone relying on their savings for income. It's about balancing security with opportunity.
Does that mean that my money can never lose value in it?
That you need to have, because even when we invest in the stock markets, okay, let's say you're buying basically units. So say you've got $10, you're going to buy 10 units at $1 each, okay? Those units are always in place unless the company funding the units go down. But let's say those units are always in place. But you cannot guarantee if those units stay at $1, go up to $10 or go down to 50 cents. So when you see losses in the marketplace at 47% or minus 30%, it means this $1 unit has gone down to 47 cents or 30 cents or 60 cents. So when you multiply out how many units you've got, this reduces your overall value. So the only capital protection 100% without risk is actually to get all your cash, put it in a pretty box. I was going to design some in 2008 because that was the only solution, right? Put it in a pretty box and stick it under your bed. That is 100% capital protection. Even sticking money in the bank because you don't know what else to do with it and nobody keeps cash at home really. Losing value because the bank's going to give you 3 to 4% and the cost of living is 6 to 8%. So to support yourself, you're going to lose money.
Okay. So it's not just about avoiding the overall risk. It's really about managing it intelligently. Is that what you're saying?
Yes.
Okay.
If I share this other screen with you, basically about how your investment is structured, okay? So there are guaranteed products, but be careful because some guaranteed products, it's not worth putting your money in by the time you pay the fees, and by the time you get your money out, you might as well have put it in under your bed or given it back, okay? So some investments are designed to return your original capital after a set term, but regardless of performance, you're going to get your money back, right? Now, the reason for you putting your money away is to get something on top of that. But the base is to have your capital protected. And then you need to look at things like structured products, high yield return potentially, but also protect the capital. So it doesn't matter if the markets get all wobbly in the meantime, you've still got your money back with a reasonable return. And then the age-old adage, diversification and balance. Even if something looks really good, you don't put 100% in, all right? If you had £2 million, you wouldn't, or $2 million personally, wouldn't advise you go stick it into one asset, okay? Because then increase your risk and reduce your flexibility. Moving your money around and spreading it around against fixed income, capital guaranteed, and having some market risk exposure, because at the end of the day, the stock market, since they started in the late 1800s, have increased in value. So we know the system works, we just don't know when.
Okay, so investors, it still gives them the opportunity to earn those returns without putting all of their capital at risk.
Yeah, exactly. You're trading unlimited upside for peace of mind and stability. I mean, the other thing I'd like to capital protection, what it can actually achieve for you. So myth one, if I put it in capital protection, I'm not going to get any growth back. Well, that's not true, right? You can still earn steady, well, it says moderate returns, but some of them are quite high returns, but it's less volatility for you. And then myth number two, this is poppycock. It's only for the wealthy. Well, Joe Investor or Susie Investor is becoming more and more. So these products are aimed at for that, the high street investors, not wealthy people. Above all, it's not complicated. If you have the right advisor and you know what you're trying to achieve and they understand and they put something in place, your risk and returns are clearly defined from the start, and it's
part of the plan. And I think that's really, really helpful. Sounds like the real issue, Annette, is that just most people don't have to explain to them clearly.
Yeah,
so
I mean,
there are a lot of misconceptions.
Yes. I mean, if you go into the bank, right? For example, financial advice, because you've got so much money in the bank, what am I going to do with it, right? You've got limited advice for a start, because that employee of the bank can only advise on ABC. If you go see a financial advisor, it depends what jurisdiction they're in. So what you have to check is what information you are receiving and if it's suitable for you. So I'll give you an example of what we do at Carey soon, all right? And our approach is the first thing, right, is so your money needs to be protected, right? A lot of people come to me and they've already had their 20, 30 years, 40 years working. They built this money up. So we've got to make sure it's safe, right? The second is, with all due respect, guys, I love servicing my clients, but the clearer it is for you as an investor, the less aggro I get. So you understanding what you're invested in and, by all means come back with questions, but you're not worried about the base of your investment and you're going to get peace of mind. And then above all, I like to offer a predictable income. Yeah, so you can plan. It's like if you go buy a house and you take out a mortgage, if you fix your mortgage rate, you know what you're paying for the next 5 years. If you fix your income, as long as it's within the parameters of you being able to do what you need to do, then a predictable income is a far better what you're trying to achieve. We're trying to cover all these points with you. So above all, you need to understand what you're invested in and how it's going to give you those returns and how your money is protected.
Love it. So I think that, really transparency really helps people feel much more in control of their finances.
I mean, there's no need for the cloak and dagger days of, we don't need to show them this and we don't need to show them that. And, clarity is the main thing. I mean, I'll give you an example of one of our investors and what we did for her. And we made sure that the majority of her money was protected and she was receiving an income regularly that allowed her to live her lifestyle, right? So it limited her downside and they could still benefit from the upside, but they knew what sort of income they were going to achieve as well. So even when the markets bob up and down, if there's bad news on the telly or there's some disaster somewhere, they can confidently still plan for their own future.
Love it. Great example of how capital protection really creates that peace of mind instead of, worrying about it and panic and anxiety, which a lot of people do.
Yeah, I mean, our money, especially if we're at that age where we don't necessarily want to start it all again. I mean, nobody to start again, but when you're younger, you've got the energy and, you can this and look at alternatives and all the rest of it. But if you've ever worried about losing money in unpredictable markets like now, then capital protection is the foundation basically of your portfolio needs. You need to start a conversation with somebody to understand what capital protection actually means for you. I'm happy to help and go into more detail. Click on the link below and book a free consultation. And like, share, subscribe.
I think you broke that down beautifully, Annette. So thank you. And in the next episode, we're going to talk a little bit about divorce, those that are widowed, and wealth, how women can take back control.
Yeah, very, very, very important this day and age. Yeah. And just to leave you with a little smile, guys, I've got a joke for you. Why didn't the investor panic during the market crash?